Hi, welcome to Retiring Well. Folks, this week we got a great show for you. I'm going to be talking about market fundamentals, long-term care options, 2 stages of investing, very important to understand, a little bit about standard deviation, and basically real returns versus average returns. So you're going to love it. Stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome back. Now listen, in this segment, I want to talk about market fundamentals. There's a lot to listen to out there when you're listening to the news, and everybody has their own opinion, don't they? But for the most part, you have to understand markets are pretty predictable. They'll, for the most part, will trade at a multiple of its earnings. Now, I know there's volatility. There's times when, and we've seen it in recent months, where it dropped 3% in one day. That's not what I'm necessarily talking about. I'm just saying, as a general rule, markets will trade based on the underlying earnings of the corporations. And as a general rule, historically, it's traded around 16, 17 times earnings. That means if it's much higher than that, we're most likely in overvaluation territory. And it's done that historically in the past. So, you know, if it's just done it for quite a long time, that's something we're going to want to maybe be concerned about. If it's trading below that or well below it, some might argue that's maybe bargain territory, right? Good time to buy in. But for the most part, it's going to track pretty closely with earnings or a multiple of those earnings. So that's one fundamental we're going to want to pay great attention to if we're in overvaluation territory or we're in bargain territory, or if it's trading right within those fundamentals. Because if it's trading right within those fundamentals, and historically not above or below, and we're hearing a lot of bad news, is it something that we necessarily need to react to right away? It could be just a lot of emotions going on due to that bad news. Okay, so if you're a long-term investor, sticking to the fundamentals and understanding where the market's trading regarding maybe those earnings is going to be very important. Another thing to understand is when you're looking at fundamentals, you want to look at all the things that drive consumer spending, or what we call small business spending as well, because 87% of our GDP is basically small business consumer spending. So how those people are feeling about the economy, whether they're spending or not, is going to drive those earnings, which, as I just previously indicated, is then also going to drive the market. So we want to look at everything that's going to affect those earnings. For example, if we have low unemployment, why is that good? Well, it means if more people are working, they have more money in their pockets, and if they're feeling confident about the economy, they're going to spend that money, which is good for corporate earnings, again, which is good for the market. So confidence levels, how people are feeling, is something that we want to pay attention to. There's a lot that goes into market fundamentals, a lot of things we want to look at, but all the more reason you want to be talking to an advisor who's paying more attention to those kind of things. At Centennial Wealth, we do. So I encourage you, if you're at somebody and you just want to kind of see where you're at and how you're positioned relative to the market, then give us a call. Hi, welcome back. Listen, in this segment, I want to talk about long-term care. Listen, if there's any question that we get asked more times than not when somebody comes to visit us, it is, do I need long-term care insurance or not? Well, the first place I want to go anytime I'm having this discussion is, what is your means to pay for that care should it happen? If I'm somebody that's saved quite a bit, and it's more than enough to cover the costs of that care when that should happen, then really do I need anything more? If I'm somebody that might be legacy minded and want to leave a lot behind and want to protect some of that, well, then that's a whole different story, right? But if I'm somebody that's saved sufficient amount away, then maybe I don't need to have any kind of insurance. We call this self-insuring. Now, just to give you a perspective of what that might look like, I've heard statistics be all over the place on this, but I've heard anywhere between 3, maybe 5 years is the average stay in long-term care, and probably the average cost being somewhere around $100,000. So what's the threat to my estate in that regard? Might be anywhere between $300,000 and $500,000 should I need that kind of care. And that's just for one person. What if I'm what if I'm a couple that's even twice that? But if I'm somebody that saves sufficient amount aside to pay for that care and I can cover that, then maybe I don't need anything more. But if I'm somebody who has not, then I'm somebody who might want to consider long-term care insurance. Okay. Now, the only drawback to long-term care insurance is there's a cost that I'm going to have to incur to pay for that insurance. It's a cost that might rise as I get older. Some do, some don't, but it may be one that grows the closer I get to needing that. The other negative maybe with long-term care insurance is that it's a use it or lose it. You know, I'm going to pay for that insurance for quite some time, and I get close to maybe needing it. Maybe I can't afford it, and now all those premiums I paid have gone for naught. But today, folks, they have what they call hybrids, and hybrids are the ability to take a segment of your savings, put it aside for that kind of care. Maybe it's a lump sum. It goes aside for that care, and then it's insuring me for that benefit. And then if I don't need that long-term care, there's usually some kind of a risk, or I should say a premium payback. Okay, that might, it's not going to get the kind of growth you might have had maybe in an investment account, but at least it's a return of premium. I get a lot back of what I set aside. So there's a lot of different features with these hybrids, but it's something, just see another example with life insurance. It's got a death benefit, but can be used for long-term care. And then if you don't need it for long-term care, at least it paid a death benefit out. So a lot of different features here, a lot of moving parts, but it's something you might want to check into, because if it's not typically just long-term insurance, maybe it's a hybrid that might be more beneficial. Well, I hope you found this valuable. If it's something you want to talk more about, then I encourage you to give us a call. We'd be glad to talk more about it with you. Folks, when I was talking about market fundamentals, it's so very, very important from a long-term perspective as you're investing, to pay closer attention to that, because earnings really do drive the market. So today, where do we find ourselves? As we look at fundamentals, unemployment is high. You've got consumer confidence has dipped. You've got small business sentiment has dipped through this pandemic. You've got elevated price to earnings ratios. So, you've got all these fundamentals that are waning, right? And yet the market was screaming upward. What's that about? Well, you got to understand the market is not necessarily, the fundamentals. It can be momentum driven. So, if there's people out there trading and they're trading on hopes that we're going to have a quick recovery, well, that, it's going to drive the market up. But so, it could very potentially be getting ahead of itself, because if we don't have that recovery, then you're going to want to see it pull back. So, the market's not always necessarily going to be the fundamentals, but eventually it's always going to find those earnings again. The fundamentals are going to matter eventually. You can't have the market screaming up, maybe on hopes, but then if those earnings don't follow, it's going to pull back accordingly. So, understanding fundamentals from a long-term investment standpoint is going to be very important, because if earnings are not following, you want to be cognizant of that and making adjustments accordingly. And then when I was talking about long-term care, I talk about this threat to the estate. Let's say it's 3 years and $100,000 per year. So let's just say the threat to the estate is $300,000. You don't have to insure for that entire amount. If you've got $50,000 income coming in regular basis, then what really is a threat? It's that $150,000, right? That you can't make up. So maybe you only insure that part. And then interestingly enough, just to give you a perspective, when I was talking about those hybrids, a few years back, I had a male, 65 years old. We looked at the long-term care insurance. It was going to be so much. And then we looked at that hybrid, that life insurance policy that had a death benefit that could be used for long-term care. And I just wanted to compare the premiums just to get a ballpark, as to how close they could come. And I found at that time that the life insurance premiums, that death benefit, that $300,000 life insurance policy versus the $300,000 coverage in long-term care, the life insurance policy was about 3 times the premiums of the long-term care insurance. Now, the life insurance was fixed. The long-term care premiums could possibly go up over time, but I found that quite interesting in perspective, the difference. And then that single premium plan where you can get a refund of your premium should you not need the long-term care. I had a male age 68 and again was trying to find out how much of a premium you have to pay. So for about $324,000 of long-term care coverage, the single premium he had to pay into this was $236,000. And if he stayed into that plan, I think it was like 5 years, he could then from there on get a full refund of his premium, but have the long-term care insurance. So again, folks, don't want to get into quotes. That's, that it's going to be different per insurance company based on your age and all that kind of stuff. But just wanted to kind of give you a ballpark of what those hybrids kind of looked, basically put a little math to it. So hopefully that was helpful. Now I want you to stay tuned because next I'm going to be talking about the 2 stages of investing and then this what is called standard deviation. How does that work? So stay tuned. Listen, markets are cyclical. You'll have long periods where the economy is in expansion, and then it's typically followed by contraction. When things go up and sometimes things go down. That's the way the markets roll. But what is not acceptable is when there's clear evidence that the market is maybe heading into recession or a slowdown, and most advisors are sitting back saying, hey, just stay the course. Listen, most are trained to follow what's called a buy and hold strategy. They figure that if they just get you well diversified, then when you hit periods like that, you should just hold the line, right? Unacceptable. If you look back in 2008 when the market dropped to half its value, it took almost 5-6 years to get back to where you were at. And if you're somebody near retirement, in retirement, possibly taking income from that portfolio, that's not going to work. So when there's clear evidence that we're entering into recession, we believe adjustments are necessary. So I encourage you, when times are good right now, take the opportunity, give us a call, let us sit down with you, see how you're positioned to make sure that that can't happen to you. So give us a call. Hi, welcome back. Listen, in this segment, I want to talk to you about the 2 stages of investing. When you're in your working years, you're getting a paycheck, hopefully you're meeting your income needs. What you want to start doing is setting some monies aside for retirement. Okay, we call this the growth and accumulation phase of our lives, or the stage of our lives, because we're trying to save. We're trying to save for that great day when we can finally not have to work any longer. Okay, but when we get near retirement, or we soon to be retired, we're entering a different stage, and it's very important to understand this because we're now entering what's called a preservation of wealth and income phase of our life. It's a whole different stage because we're rapidly getting to that place where we're not working any longer or not going to be working. We can't grow and accumulate assets anymore. We're going to have to rely on that nest egg for an income. So what's my attitude or risk tolerance now at this time? When I was in the growth and accumulation phase of my life, if my account dropped quite considerably in any one year, doesn't really have too much of an effect on my life because I have that paycheck, I have that income coming in, my needs are being met, and I have time for that asset to come back to where it was and possibly again grow. But if I'm getting close to retirement, I'm soon going to get there and I have to rely on that savings to now be income for me. Can I afford to have that account drop significantly? Do I have the time to be able to wait and have that come back? I might not. And folks, if I'm actually in retirement and I no longer have any other income but that portfolio, maybe Social Security, then it's going to have a drastic effect on my lifestyle. So understanding this stage and what stage I'm in is going to be very important, because how I invest appropriately is going to be different under both those scenarios. So why are we having this conversation? We see too many times where people are coming in, they're getting near retirement or they're in retirement, and they're invested exactly like they were maybe in the growth and accumulation phase of their life. Very, very dangerous, because if in that previous stage that they were in, they were taking a lot of risk, and now they're bringing that into this next stage. Again, what are they going to do if the market drops dramatically and that income plan gets blown apart? So very, very important to speak to an advisor. We encourage you, give us a call to make sure that whatever stage you're in, you're invested appropriately. So give us a call. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, welcome back. Listen, in this segment, I want to talk about standard deviation. Now, this is financial jargon that we use in our industry, but I want to make you understand what it is and why you want to know more about this, okay? First of all, this is a bell curve. It's going to represent, this line here is going to represent an average rate of return of 6%. Okay? Now, why we have this bell curve is we want to understand what could possibly be the range of returns, that could deviate from that average. So let's say we had a standard deviation that was equal to 10. Okay? All that represents is that there's a 68% chance that it could deviate from that average by 10%, either way. So 68% chance that we could have a minus 4% return or a plus 16% rate of return, okay? Now, in the bell curve, it also represents where the range of returns could deviate 95% of the time, but by another 10%. So in this particular case now, 95% of the time, we could see a range of return of minus 14 or plus 26. All right? Now again, based on the bell curve, represented by this line, it says that 99% of the time, the range of return could deviate another 10%, meaning we could have minus 24% or plus 36%. Now, why is that important? Let's say I'm somebody that only wants to lose 5–10%, maybe. Say 10% is the most. But based on an average rate of return of 6%, okay, and a standard deviation of 10, I could possibly lose 24%, 99% of the time, or gain 36%. So if I'm that person that only wants to lose 5–10%, but it's possible I could lose 24%, then I'm not going to be happy with that. Okay? Now what is this 1% that it's not representing? Those are black swan events. Those are unexpected things that happen that were unexpected that could drive it even farther from these ranges, meaning it could possibly lose 1% at a time, lose more than 24% or gain more than 36%. Now, look back 100 years, I dare say we've had more than just one black swan event. They happen a little bit more occasionally than we think they do, but that's what that's representing. Now, any portfolio we can take a look at, and we can look at the whole thing and actually tell you, one, what is its average rate of return, what is the standard deviation, so you know the range that you're comfortable with. Very, very important in risk analysis. So I encourage you, if you're somebody that wants to know that, give us a call. Hi, welcome back. Folks, listen, when I was talking about the 2 stages of investing, and I cannot stress this strongly enough, you've got that, your investment strategy you have during the growth and accumulation phase. But when you get near retirement and you're in that preservation of wealth and income phase of your life or stage, listen, you don't want to be invested the same way. We've watched in the last couple decades now, the market dropped to half its value, right? In 2000 through 2002 with the tech bubble, and then you had the credit crash of 2008. If I'm somebody that's needing that portfolio for income, can I afford to have it drop to half its value? And again, if I'm taking income, how long is it going to take me to, get that back? So very critical to understand. And then just know this, we have the ability at Centennial Wealth to take any portfolio that you have as it sits today and show you how it's done the last 20 years. What was that drawdown? What did it actually lose in 08? What did it actually lose in 2000 through 2002? Wouldn't you want to know that? So folks can't stress that enough. If you're somebody out there that's unsure how you're positioned and you are that person that's near retirement or in retirement and you're concerned about that, then give us a call and we can do that analysis for you and we can go over it with you on the phone. We are meeting at the office. We're trying to take the proper precautions, not two people meeting at the same time and those kind of things. So, if you're that person, then certainly give us a call. And then standard deviation. Hopefully you found that valuable. It's odd. They got those 1% tails on the front and the end, and they tell you that only 1% of the time are you going to get these black swan events. But look back, folks, 100 years. I would dare say we've had a lot more, black swan events than just basically, one time or 1 year. So, and I dare say this one we find ourselves in right now, this pandemic was a black swan. So, you want to be very cognizant of that. And then just remember this, when we do an analysis, we can show you what that standard deviation is. So not only knowing what the drawdown in the past was, but what is the potential outcome of that portfolio going forward? What's the variation or the ranges? So anyway, if you're that person that wants to know that, give us a call. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at cen-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Hi, welcome back. Listen, in this segment, I want to talk to you about real return versus average rate of return. Two different things. So let me illustrate. Let's say you had an investment or portfolio that made or lost 50% the first year. Okay, it made 50% the second year. It lost again 50% the third year, and then again made 50% in the fourth year. Wouldn't you say that's a pretty volatile investment? Funny thing though, if you do the math on that investment, they would tell you that that portfolio or that investment averaged 0%. All right? But what if I had $100,000 Okay? In the first year, it lost 50%. That means now my investment is down to $50,000. Okay? Then in the second year, it made 50%. Now I'm back up to $75,000. All right? Then it loses 50%. Now it's down to $37,500. And then lo and behold, the fourth year, it's back up 50%. Now I'm at $56,250. Now, for an account that averaged 0%, this portfolio really lost 43.75%. Now, that's a big difference. And if you look out there in most portfolios or investments, what is the return they're always trying to give you? Most generally, they're going to give you the average return. But the real return is much, much different. Now, I recognize that this is an example that's grossly exaggerated, because how many investments do you see losing 50% and gaining 50% year after year is? But very vitally important to understand the difference between the two different numbers, between real and average, because if I'm looking at my investments and I'm just looking at the average and it has a high degree of volatility to it, then what is really my real rate of return? Very, very important to understand, very important to know. If you're somebody that wants to know the volatility of your portfolio, most importantly, how it operated in 2008 in the last recession, so you can see what kind of volatility it could possibly have, then you're going to want to give us a call.
Hi, welcome back. Now, folks, I recognize that was an extreme, right? You know, you got this investment losing 50%, gaining 50%, you know, and you talk about standard deviation, that would be a big one, right? But I just wanted you to get that concept, because, you know, you see all these investments out there. What are they always putting forth? You know, they want you to see their averages, right? You know, it used to bother me when '08 was still within the 10-year range, and you'd see these 10-year averages, you know, and so people are looking at it and say, well, it's averaged pretty good, but they weren't taking into consideration that in '08, that portfolio lost a significant amount. So, you know, was average return enough? No, you know, I wanted to understand the volatility of that portfolio. So looking at the real return would make much greater sense. The charts I love are the ones that show, you know, the investment at a certain amount and a certain period, and then you can see how it did over that time. So you can see the real results, but you can also see, when you look at that chart, you know, the drawdown, you know, how much did that lose in particular points. So would that be an account that I would want? Maybe not. And maybe I want a portfolio that can average the same amount but had less volatility. Would that not be important? I might have had one that maybe, you know, made 6% but was very volatile, and another that maybe averaged 6% but was less volatile. Which one would I want? Obviously, we'd probably want the one that's less volatile. So anyway, folks, just trying to give you, you know, a good understanding of that and why it's important. Again, if you're somebody that would like to have somebody do an analysis for you, look at how you're positioned, you know, again, what's that standard deviation? What were those drawdowns? Then give us a call. We'd be glad to help you with that. Thanks for joining us this week. Stay tuned. Next week, we'll have some more for you. Thank you.